Okay, listen, gentlemen, I'm happy you are flowing with me. Now, let us attempt this particular example. A company currently takes 40 days credit from suppliers on the basis that this is free finance. Annual purchases are $100,000 and the company pays overdraft interest of 13%. Payment within 15 days would attract a 1.5% quick settlement discount. So if we pay early, we are going to enjoy a 1.5% quick settlement discount. Should the company pay sooner in order to take advantage of the discount? That's the question, ladies and gentlemen. All right, so I want you guys to pause the video. Okay, just pause the video and attempt this simple question on your own. So, to obtain the discount, it means they have to pay 15 days sooner. Okay, so that's that's 25 days sooner. Okay, 25 days sooner. All right, and this means that instead of paying 100%, they are only going to pay 100 minus 1.5, which is the discount. This comes to 98.5%. So they are only going to pay 98.5%, right? Provided they pay 25 days sooner. So what is their return? So the return, if they take the discount, the return would be 1.5 over 98.5, right? And this gives around 1.5 to 8%, right? That's what they are going to get. All right, if you like to use the decimal, this comes to 0.015228. All right, so that's the return they get if they take the discount. All right, but what is the effective interest rate if they don't take the discount? Right? So we know the formula 1 plus r is equal to 1 plus r to the power 365 over the number of days, okay, of the number of days early or number of days earlier, something like that. Okay, so 1 plus r is equal to 1 plus that decimal number, which comes to 0.15228, all to the power 365 divided by 25 days earlier. All right, and this comes to r is equal to 24.69%. Okay, that's our r. Okay, now the R is, the cost of foregoing the discount is 24.69%, and the overdraft rate is 13%. So what shall we say about these figures? All right, so if we do not take the discount today but pay later, the cost of that action is going to be 24.69%. All right. But if we borrow money today and pay for the discount, and pay for the goods, all right, we will incur a 13% overdraft charge. So it is actually better to go for the discount where we pay 13% overdraft charge, rather than to wait and pay later, where we get the overall effective interest rate of 24%. So the discount option is better and cheaper given the circumstances. All right, thank you. Well, there are a lot of questions. I'm going to dedicate a video again from a past exam paper where we'll go through a question on this area so that you understand what I'm trying to say. All right, let's talk of the method of paying suppliers. Okay, what method are we going to use? Because in the examination, we might be asked on which methods could be used by the company. We might pay suppliers using our own cash. Okay, I mean the cash we have at hand. We can use the checking. All right, but we can as well use what are called standing orders and direct debits. A standing order is when the payer agrees to pay a constant amount per period, per month, to a payee recipient. This one is normally common if you buy goods from a if you buy furniture from a furniture seller or a furniture store, they normally give you some hire purchase agreement. Okay, and that is a standing order agreement, or let me just say a stop order, something like that. All right, so in that arrangement, you are only going to pay a constant amount. But in other situations, you can then use what is called a direct debit. All right, this one is when the payer gives authorization to the payee to transfer amounts as needed from the payee's bank, from the payer's bank to the payee's account. This one is most strenuous because you are giving the company from whom you have taken some furniture or some goods the right to deduct whatever amount they feel or they deem fit at a particular point in time. It's very painful, this one, but it sometimes happens. All right, then you might as well use electronic funds transfer, okay, or internet banking, something like that, where you can pay through the online banking platform, something like that. Now let's move to what is called receivables management. We have covered the payables management area. Now is the receivables management. Many of the same principles apply to receivables, to receiving payment from customers. Okay, the principles we have been speaking about the payables management also apply in receivables arena. Typically, customers will be given 30 days of credit, and to encourage payment within that time, discounts are often offered. The annual cost of giving discounts can be surprisingly expensive. So the finance manager has got a hurdle of deciding if he is going to collect receipts quickly to reduce the cost of financing debtors. At the same time, he is also faced with the decision as to whether to extend the credit period to encourage additional sale. That's the idea in receivables management. What are the costs involved in a receivable? Remember, receivables are credit customers or credit sales. All right. So what is the cost involved when we allow customers to take our goods on credit? There is what is called an administrative cost to record and collect the debts, the general ledger management costs, or ledger fees. It's very strenuous to manage those receivables. So somebody has to be paid, either the the credit controller or the accountant. Somebody has to be paid. Then there is cost of irrecoverable debts. Some debts might not be recoverable in the end, so it's again a cost. Then the cost of the discount is, if you give a discount, it is a cost, it is an expense. Okay, discount allowed, it's an expense. All right, so it's given by the sales multiplied by the percentage of the discount multiplied by the percentage of customers who are going to take the discount. Then we have got what is called the finance cost, which is the average receivables multiplied by the interest rate. Okay, the finance cost is also going to be involved. Let's do this particular example relating to Greencroft. Okay, we need to do this particular example. Greencroft Limited has sales of 60 million for the previous year. Receivables at the year end were 8 million. The cost of financing debtors is covered by an overdraft at the interest rate of 14% required. Calculate the receivables period. Let us compute the receivables period. Then we need to calculate the cost of financing the receivables. Okay, so ladies and gentlemen, I hope you have paused the video and attempted the question on your own. Now, when you meet a question like this, you need to ask yourself, Mr. Examiner, how many days are in a particular in this particular year? Okay, sometimes the examiner might say use a 360 year, a 360 day year. Sometimes he says 365 days year. So be careful to that instruction. However, if it doesn't tell you how many days in a particular year, then you need to be play it safe and use the 365. All right, so let us assume it is a 365 day year. So in that case, we can calculate our receivables period as the receivables, okay, the credit sales or the receivables over the total credit sales. All right, multiply by 365 days. So in this case, if we use our calculators, we are going to get our 48.67 days. So that's the receivables, okay, divided by total credit sales. The receivables at the end of the year divided by the credit sales. So we just have to assume that these were on credit. The sales were on credit. All right. Now, what about the cost of financing receivables? We have learned that the formula for the finance cost is the average receivables multiplied by the interest rate or the overdraft rate. So in this case, the receivables were 8 million. Okay, 8 million is given. 8 million. Okay, sometimes you'll be required to compute the average receivables, which means you need to use the opening receivables plus the closing receivables divided by 2. Okay, as the average. You need to obtain the average receivables. Right. So in this case, we have got 8 million multiplied by 14%, and this should give us 1.12 million. And you're done. It's very simple, isn't it? Thank you. See you in another example again. Reynolds Common makes sales of 1.2 million. Okay, makes sales of 1.2 million per year and currently offers no discount for prompt payment. Accordingly, customers are paying after 60 days instead of the required 30 days. The company has estimated that if it offers a 2.5% discount for payment within 30 days, 80% of its customers will pay in that time. Calculate the annual effective cost of offering the discount. This is more of an exam standard question. So pause the video and do this question on your own. Okay, so we are having a company that has got its customers who are paying after 60 days instead of the required 30 days in practice. So the company has estimated that if it offers 2.5 discount for payment within 30 days, 80% of its customers will pay in that particular time. So we are required to compute an effective annual percentage cost of offering the discount, the annual percentage effective cost. So let us assume that the invoice value is $100. Okay. So invoice $100. Okay. That is after 60 days. All right, but some customers, okay, 80% of the customers are now saying that no, we can settle this, we can settle the invoice in 30 days. So the majority of the customers are saying that no, let us, settle the invoice in 30 days. So in that case, there is a benefit, okay, that is going to be enjoyed by the company. All right, the benefit is not the 2.5% benefit, but rather this 97.5% extra cash they are going to have in a month instead of waiting for that cash in 60 days. Yeah, in additional 30 days, they are going to get the cash early, 30 days earlier. All right. So they are going to get $97.5 30 days earlier. All right. So that's the benefit they are going to get. But the $2.50 is going to be the cost. All right. Their customers are going to pay $97.50 30 days earlier instead of this company waiting for the full 60 days. They are only going to wait for 30 days and they are going to receive the $97.50 earlier. All right. So now, what is the cost? The cost is the $2.50. Okay, for receiving the $97.50 earlier, you're going to suffer $2.50. Right, so that's $2.50. All right, over 97.5. This is now the cost. It's not the return, it's the cost. Right. So the cost, which comes to 0.02564, right? And then we then have to compute what is called the effective cost, the annual percentage effective cost, which then we will use the same formula: 1 plus R is equal to 1 plus R to the power 365 over the days earlier, the P, days earlier. In this case, they are 30 days earlier. So 1 plus R is equal to 1 plus 0.256 4 to the power 365 over 30 days. All right, so this comes to 1.36. Right, so R subject to the formula will come to 36%. All right, so in terms of for decision as to shall we proceed with the discount or not, the question did not ask you that, but that decision is likely to be informed by the rate of the overdraft. Okay, if there has been an overdraft, say of 20% overdraft charge, if we were given an overdraft charge of 20%, then it simply means that going for the discount is not a worthwhile attempt, because it is better to just borrow monies and settle our working capital needs now, because we'll be charged 20%. However, if we give the discount, then the overall effective cost is actually 36%. This is the overall effective cost of giving the discount. So if the overdraft rate is 20%, then we are better off, borrowing more money from our banker and pay an interest charge of 20% rather than the 36%. Are we together, ladies and gentlemen? But that was not asked for in this particular question. Okay, there is an which talks of this. I think okay, yes, this particular example talks of that issue. Okay, but before I do this particular example, allow me, ladies and gentlemen, to just skip it for now and talk of this, which is more directly linked to our computations so far. Okay, because we just want an example that incorporates the the formula for effective interest cost. All right, the effective percentage cost. That's what we want to use.